All I think about every day is what can go wrong. True story, up in Westchester, in New York, very enterprising criminals sat on a hill with binoculars. And they saw all the families picking up their kids. And because the school was kind of hoity-toity, private school, they had plaques on the dashboard of the family name. They just sat and wrote them down. Figured out where they live, and then they figured out the breaks because the school published the calendar of when the kids were on spring break, and they called up. Well, most families don't answer their own phone. They have staff that takes messages or goes and gets them, however they handle it. And they said, oh, we're from the school. You never responded if your child is going to be attending the spring break program. And to be helpful, because that's what we tell them to be, much of the household staff would say, oh, no, they've decided to go to Aspen, or they're going to Florida, or whatever, before the homes got robbed. Just like that. The household staff, if they're not trained to both protect and be a gatekeeper and a block for the family, as well as serving the family, you have a problem. Protecting your health records, well, now that's an issue, because you're getting tests and people see the name of the patients, and that's all that goes into it. Protecting your trips, people love to print out their itinerary when they're traveling. They may leave it in the hotel room. Well, they're a kidnapping risk. If you're a family office and very wealthy, you're already a target, so your privacy concerns are tenfold over what they would be for anybody else.
Hey everyone, this is Prashant and I'll be your host for the VC10x podcast, and today we have Wendy Craft with us. Wendy is a family office veteran. She has worked with multiple wealthy families, helping them with asset allocation, risk management, tax optimization, governance, and more. Wendy serves as the CEO of the Elle Family Office, a single family office in Atlanta, GA. The office handles the holdings of the Lazarian family, which includes real estate, exotic cars, and various other investments. In this episode, we talk about the importance of structuring a family office and different aspects to keep in mind, different ways of tax optimization utilized by wealthy families, privacy risk faced by wealthy families, how does political and market environment impact family office strategy, wealthy families really happy in their lives, and lots more. So without wasting any time, let's dive straight in. This episode is sponsored by my own podcasting agency called Podcast10x, where I help venture capitalists, asset managers, allocators, and family offices in starting their own podcast and building a strong brand. Podcast10x is designed in a way to work well with the busy schedule of investors, where we handle every aspect of podcast production so you can focus on investing. If you're looking to build a strong investor brand, starting a podcast should be right up your priority list. It's the only form of marketing where you can showcase your strong network, in other words, access to limited partners and founders, and grow that network further. And contrary to what most people hear, it's still very early to start a podcast. There are at least 10x more newsletters and 1000x more blogs than there are podcasts in this world. You can learn more about our podcasting services at podcast10x.com. I'll make sure to add the link in the description below. Enjoy this episode. Hey, Wendy, so good to have you on the VC10X podcast. How are you doing?
Good. Good morning.
Very good morning. Thanks so much for making time for doing this episode with me. And to start things off, can we first have your personal story and your personal experience with family offices?
So I fell into it like everybody else, because that's how you get into family office, over 20 years ago. So it's been a while. And I started working for a family up in New York City, and then ended up setting up family offices for some of their partners. And then last year, I came down to Atlanta, Georgia, and I'm commuting from New York to do the same thing down here for a nice family.
That's amazing. How important is it to, structure a family office, and what are the different aspects involved in that?
So opinions vary. And you'll see all different kinds of structures, from maybe something that's very simple to we have an office, we have some trusts, and we have some investments, to what I'll give a shout out to Tom Handler would call the modern family office, which is a much more complicated bit of structures, which not only takes care of the trusts and the wills, but it's also a great deal of asset protection. So if anything happens, you can't lose all your assets because maybe an heir showed poor judgment when driving while inebriated or something. You want to make sure it's all protected. And that can go to complex tax structures as well.
Absolutely. And we always see, new family offices emerging, and it's a growing space, a lot more family offices coming up. So when families are thinking about, structuring as a family office, what are the key things they should be thinking about to start with?
Well, I get this a lot. Like, should I have a family office? What should I think about? Why am I doing this? When you have a business, and most people have a business, that's how they create their wealth. And it can be air conditioners, jewels, John Deere dealerships. You have a business. And the employees in your business, as loyal and as wonderful as they are not trained in family office. So they may go home at night and say to their family and their cousins, hey, you'll never guess what they did. They bought a Rolls Royce today. And you start handing checks for charity to your receptionist, and it's more than her annual salary. And that can breed resentment. And then you're taking your CFO, who is a really good CFO and knows how to align the books, but they might not know the first thing about alternative investments and how to invest in them. So you're asking things of your staff that you shouldn't be asking because they're not trained in it. You're risking your privacy because most employees, there are actual websites where employees complain. You know what ones they are. They complain about their working conditions. I mean, that's horrific when you're dealing with an iconic family. And it could be a famous athlete, it could be a movie star, but it's somebody of great wealth. So you have a lot of problems that you need to take it out. Now, the middle step between family office and embedded, so that's like an embedded family office, you're having your family office run out of your business. Then you have a multifamily office. Multifamily offices, they're great. If somebody does not want to go to the time and the expense of setting up a family office, they can use a multifamily office, and they can do most of the things. They can pay your bills. They can do your investments. Most of them will not do legal work, so you're still going to have to use accountants and lawyers, but a lot of times they'll communicate. It can be a good solution for that person that just wants to, was Charlie Lowenholt call it, freedom from wealth, doesn't want to have to deal with it all the time. But you are not getting complete privacy, right? So family offices may have 100 families or 500 families, and they're very good, very confidential at what they do, but you are sharing them in a way, which is good for cost, but it might not be the right thing for every family. I also know families that have their own family office and then put investments with a multifamily office. So I'm gonna pick on like a real estate family. You do real estate, you're great at real estate, you know nothing about venture. Do you go into a venture fund? Or do you go to a multifamily office and say, I need alternative investments in venture. Can you allocate that for me? And then there's two kinds of multifamily. You have like your Goldman Sachs, where there's embedded fees, and then you have an open architecture where they just charge you like a fiduciary and asset management fee. And then we get to the single family office. Well, the best thing about that is you can protect your assets away from your business. You have complete and utter privacy, confidentiality. You can do a lot of legacy training, although some of the MFOs and other groups are starting to get into it. You can do a lot of legacy training for the next gens. And everything is confidential. Now, even most single family offices will outsource some aspects. It might be legal. Usually not accountant, but sometimes if they have a lot of multi-state interests, they're not going to have somebody who's sitting in a certain state dealing with all of that. They will outsource to a firm that has offices in 20 states or whatever, and have them prepare those tax returns. So even though we think, oh, single family office, they do it all, they don't, right? There are aspects, and there might be investments they outsource. So that's kind of what you have to look at. Where do you fall in that gamut? What works for you? How much privacy? How much cost are you willing to bear? That kind of stuff.
Absolutely. Yeah, that's quite interesting, and glad how you put it into perspective. How both the structures are different from the other, right? And talking about the capital allocation and preservation strategy, because those are the more often than not the primary goals for a family, that you want to grow the capital, and more important than that is that you preserve the capital, right? So as someone who has worked with family offices over the years and still working with a family office, how do you do that part? How do you derive at that strategy that suits a particular family for their preservation and their capital growth? And I believe that'll be different from for every family, but as someone who manages that, who is in charge of that, how do you think about it?
So I think about, and all I think about every day is what can go wrong. And I think most CEOs of family offices, you wake up and that's your entire being. What can go wrong? Well, we have to have this trust in case you die. We need this will in case you die. We need insurance in case you die. If the real estate market tanks, what are we hedging against that? If capital drives up for venture, and we think a lot of the startups are gonna fail, what am I hedging against that? How much am I putting there? So a lot of it goes into what can go wrong and what can I do in a portfolio construction to make sure that we're preserving the wealth. Now, it is different on every generation, and that's something I think people miss when they start talking to families is how that works. If you're talking to the first generation, they built it, and they're going to kind of stick to where they built that wealth, right? If it's hedge funds, they like hedge funds. If it's private equity, if it's real estate, it's kind of hard on that first gen to get them to want to diversify that out. It takes a while. So, I always would ask people, if I was looking to talk to a family, what generation are you on? And how did you build your wealth? It's a much more polite conversation than, hey, how much are you worth and what size checks do you write? Which never works really well with people. Um, but you can tell a lot by that. If somebody says real estate, I'm going to guess that they're probably not doing hedge funds if they're the first generation. Now, if they're using a multifamily office, they might be. If they're on a second generation and that second gen family member went and took an MBA, likely they're much more interested in diversifying. If they're younger, they're much more into AI and tech because they know that's where the world is going. So it's generational. It's how they built their wealth and the extent of which they'll allow you to construct that portfolio. If somebody just said, do what you think is best, I'd be like, oh, I'm doing this, I'm doing that, I'm putting that there to hedge against this. So it's very intensive with the type of investments the family is comfortable with. And then we have cultural issues, right? So there are some cultural issues where families simply do not want to be in certain asset buckets for certain reasons. And I can pick on one family, I won't do it by name, but his grandfather was a huge tobacco producer. I mean, he's the name in the tobacco industry. And on his portfolio, the last thing he wants to be in is tobacco for a variety of reasons, social reasons and everything else. So he might not want to do that. I think you find that real estate families, by and large, feel that they can do a better job buying and selling real estate than any fund. So I always tell real estate funds, don't look for the real estate families. Go find the hedge fund families, right? Because they want to allocate to it and they're not going to be hands-on because they didn't make all their money in real estate. So all that goes into consideration.
Absolutely, yeah. That's quite interesting. That sometimes if you are into an asset and you go out looking for the same asset, they already have that access and they probably don't need you, right? And versus them not being in the space and you reaching out, then they can diversify using you, and that can be a good approach there. Very interesting. You mentioned how a family that where the wealth originated from the tobacco industry, but the newer generation doesn't want to invest in that space or doesn't want to be associated with that.
Yeah. Look at the Rockefellers, right?
Mhm.
They just diversified out of oil.
right?
Right?
It's
So
yeah.
so that will be a generational shift in portfolio construction for the family.
Yeah. And how easy it is to do that for future generations? Is it the 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 first generation, did they not, set it somewhat in a law or a rule book that okay, this is how we're going to invest because I'm the person who is responsible for all this wealth, and I should have some say on how we go on investing in this family, right? Even after they go out, is there some sort that sort of thing out there, or or it is solely dependent on the discretion of the present generation who is in charge, and they can invest whichever way they want?
I think more that you'll see that there's a don't do instead of a have to do, if that makes sense. I mean, nobody knows what the future's doing. And if your wealth was tied to you must invest 50% in real estate, and I don't know, there's a governmental shift and real estate is no longer owned individually, you're done. But you will see families, instead of saying you have to, they'll say you can never. So this family, they'll put things in the trust where it's a mandate that they can't buy guns, or if somebody, depends on the state too, but if somebody's involved with drugs, they may lose their ability to be a beneficiary. So they'll put things in that are more like, you can't do this and you can't do that. But I don't think I've ever seen you have to invest in this, because just think about it. If you're one of the older European or Indian families, and that's 500 years old, what are you going to put in there? You have to invest in candlesticks, right? And so I think
Yeah.
most people understand that the world is changing and investments are coming that we can't even picture. So instead of saying you must do this, they're more willing, just like parents, right? You can't do this and you can't do that. And if you ever marry so and so, you will be kicked out. Um, and just like regular parents, they're more willing as the generations go down to say what you can't do as opposed to what you have to do.
Yeah. Yeah, I love it. And I think that's also a great mental model. When you can't decide what you have to do, I think it's better to first, put out things that you don't want to do or you should not be doing, right? And that's a great way to arrive at what you should be doing, right? So that's great. And you mentioned how there can be a set of rules that can be set by a generation, right? So how is that structured? What's the organizational structure to do that? Is that called a trust, or is it called something else?
A couple of different ways. One of the biggest ones, and people can Google this and find an example online, is a family office mission statement. So you can say our mission together is to do good works and, blah, 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 blah. And then you have a family office constitution, also which you can Google. Google example of family office constitution, they pop up. I think JP Morgan has a pretty good one. And this is how we're going to deal with certain things. Are we going to allow the people you marry to have a full say in the family office? Are we going to allow adopted children to be treated the same as natural children? What kinds of things will take away your right to be a part of the family beneficiary? There is all kinds of stuff, and you can put that in your constitution. You can also do it through the family council and governance, and a lot of people will put limits in their trust agreements. If you have a dynastic trust, you can say you will not be able to access this money until you're 25, and you're going to be a steward of the money. It's not just for you to go buy a yacht and brouhaha. You have to be a steward for the next generation. So there's a whole bunch of little places where you can put that in there, so people know what's coming, and they should know young when they're 15, 16 years old. Look, here's our rules. Just like any country, here's our constitution, here's what's expected of you, and here's what can get you in trouble. And then we're going to take the trust and make sure you darn well can't do it.
Absolutely, that's quite interesting. And are all these rules set in stone once they are in the family office constitution?
No, think of the United States Constitution, right? We can do amendments, right? It's a big deal to do one. A lot of people have to agree, but we certainly can do it. Otherwise, women still wouldn't have the right to vote, right? There would be a lot of bad things going on in our country that as we got older, we realized, yeah, that's not a good idea. Let's just amend it. We didn't throw it out, but let's amend it to bring it up to the modern times.
Absolutely. And what is a family office trust? Does every family office have a trust, or at what point do they need one?
Well, we do trusts in the United States for a couple of reasons. We do them for tax reasons, which is a big one. And there's all different kinds of trusts. So you can have a dynastic trust, which is for children. They can pass it down. You can have spousal trusts, slats. And usually the wealthier the family, the more complicated this structure gets. You start with a dynastic trust. You may have a living trust to put assets in that converts to a non-revocable trust when you die. There is 101 structures that you can do, and it depends on the country you live in and sometimes the state you live in for where you would want to cite as that. So the laws are different. So in the United States, North Dakota, Montana, to some extent, Wyoming, Nevada, Tennessee, Delaware, California, New York, they're very popular places because they allow a dynastic trust, the privacy laws, so people being able to pierce to find out who the beneficiaries are of a trust are really protected. A lot of families need that. Some families go the big jump up to a private trust company. They have a trust company just for their family. Those are gaining in popularity. So it really depends on the wealth, the amount of the family members, and what they want to put into place. Usually, if you're worth $10-20 million, that's where somebody says, oh, I have 3 kids. I'm going to make 3 little trusts just for them. I'll put $7 million in each one, and they'll take care of my grandkids. I don't have to worry about that. So that's a simplistic, high net worth kind of solution. But as you get into families, it's a lot more complicated.
Right, absolutely. You mentioned trusts, how they can be a great way to, optimize taxes. What are some great ways for family offices to optimize for saving on taxes and tax structures that help them in wealth preservation?
Oh, geez, you need specialists for this, right? This is a very big deal. There are some countries that have specialized St. Kitts tax laws that help shield taxes. There are states in the United States like Texas and Florida and Tennessee. There's no state income tax. So many times people will put their trusts there so that there's no tax when they sell assets within the trust. Life insurance is one of the best things out there because it's not taxable. You pay into it. It gets, Mary, Joe, and Johnny get the life insurance and there's no tax. You're allowed to give certain gifts, an amount of gifts each year that's not taxable. So, and then at a certain point it becomes taxable. There's just all kinds of different things you can do. Here in Georgia, we have a I'm going to call the film tax. So people can actually, just like carbon credits, buy film credits and offset their income. There's 1031 structures for real estate so that you don't have to pay the tax. You can roll one property in another. I mean, it's a whole business. And family offices are always looking to how to minimize the tax obligations, not only for themselves, but the next generation.
Absolutely. Yeah, that's quite interesting. And on the gifts part, I think that's kind of a very vague term to be able to send out gifts without them being taxed, right? Because a lot of things can be put in there and be termed as gifts, right? So is that specific to a certain location that you can only do it if the trust is, located in a certain geography, or is it like open everywhere it's allowed?
So it's U.S. That's U.S. tax law. And I'm going to be careful what I say because we may be sunsetting. So this is the big issue going on in family offices right now is will the incoming president extend this law or is it going to go back? So right now, there's a set amount that you can put into trust. With a couple, I think it's it's about 13, a little over 13 million each they can put into trust. Then each year they have an amount they can gift outside of that bulk amount. So there's a lifetime exemption, and then gifts. I don't know what's going to happen. I would probably put $20 on the fact that they're going to get extended. But if a whole bunch of other things are going on in this country, that just might slip through the cracks and they may forget to do it in time. Another good way to do things is, property can get a step up in value on date of death. And that kind of was never touched until about the last 10 years, and it changed back and forth. But, if you gift a property that has a basis of 0 and a ton of taxes owed on it to your child, and then you die, they get the step up. So they get it given to them at fair market value. So there is no old tax owed. So it's just all this stuff. I would say if you really want to get into it, every year in January is the Heckerling Institute in Florida. And it's a whole week of trusts and estates. And it's a great place to go and start learning if this isn't something you trained in.
Yeah, quite interesting. I think that's a great space for people to dig into, especially for people who are interested in wealth management and things of that sort. Let's talk about how the market conditions, like maybe the interest rate or things of that sort, and the political environment, maybe Trump getting elected and things of that sort. How does that impact family office investment strategy?
A lot. I mean, this morning, while we were talking, I'm sure the CPI came out, the Consumer Price Index, and that's going to determine if the Fed lowers interest rates or keeps them steady. That affects our mortgages just like anybody else's, your interest rate that you're paying, the credit cards you're paying, and everything else. So we're not really sure, if that's going to continue, those last couple of cuts we got, if we're going to get more cuts, if we're staying the same. If they raise it, that's bad. So you're always keeping your eye on certain things like that. The tariffs that may go on may affect family offices, in that those that have in a business that they're still operating. A lot of families still have a business. Some people get this crazy idea that a family office has no business interests and they just sit on the yacht drinking champagne, and that couldn't be further from the truth. Most of the families I know are working very hard. Take Larry Silverstein, with the World Trade Center. They put it back up. Different, but they put it up. They're not sitting around going, oh, let's just do nothing all day. So, it kind of depends on how all those little taxes go into play, a little geopolitics, like how is this going to affect me? And do I need to move some investments over here because of this? So I don't really know how it's going to play out. I think the next 6 months are going to be really interesting. A lot of the families in real estate are very concerned about the tariffs because of this deal, right? And the cost of goods to put up buildings, to put up housing, or whatever it is they do in real estate. So that's a big deal. Those, and I know some that own a ton of hotels and restaurants, is the cost of wine going to go up because it hits their bottom line. So maybe they want to take some money and hedge against it in another asset class. So it's I don't know, it's family office chess, and we'll know a lot more in 6 months.
Right. Absolutely. Yeah, quite interesting. And tell us about the importance of maintaining privacy for family offices, right? And maybe some instances where the lack of privacy or a lapse in privacy caused some, bad instances for some families, if you can share those.
Well, privacy is very important because a lot of what goes on in a family office really can't be out in the public. And I get that it's fascinating, because if it wasn't fascinating, the show Succession would not have done really, really well, right? People just are really into this. But we're talking about privacy on a different level. And I think you and I were talking about, I'm going to give you an example. Um, the household staff, if they're not trained to both protect and be a gatekeeper and a block for the family, as well as serving the family, you have a problem. And true story, up in Westchester, in New York, um, very enterprising criminals sat on a hill, and one of the security companies that provides protection for families told me this, with binoculars. And they saw all the families picking up their kids. And because the school was kind of hoity-toity, private school, they had plaques on the dashboard of the family name. And they just sat and wrote them down. Just wrote them down. Figured out where they live, and then they figured out the breaks because the school published the calendar of when the kids were on spring break, and they called up. Well, most families don't answer their own phone. They have staff that takes messages or goes and gets them, however they handle it. And they said, "Oh, we're from the school. You never responded if your child is going to be attending the spring break program." And to be helpful, because that's what we tell them to be, much of the household staff would say, "Oh, no, they've decided to go to Aspen, or they're going to Florida, or whatever." 4 of the homes got robbed. Just like that. Privacy is very important. So those kind of details shouldn't be showed. I think we're all grown up enough to know that we shouldn't say whole families in Costa Rica, nobody's home. And we're smart enough to know not to do that these days. I think as a group of humans, we've gotten much better at protecting our privacy. But they're already a target. If you're a family office and very wealthy, you're already a target. So your privacy concerns are tenfold over what they would be for anybody else. And, if I got cancer, my family would be very sad. When King Charles got cancer, it was on the news for months and months and months. And the same way it would be if it was Elon Musk or Jeff Bezos. So protecting your health records, well, now that's an issue because you're getting tests and people see the name of the patients, and it's all that goes into it. Protecting your trips. People love to print out their itinerary when they're traveling. They may leave it in their hotel room. Well, they're a kidnapping risk. And so privacy issues have to kind of enter in a way you don't think before. Our website for our family is purposely blank. I'm going to add some things, but I'm not adding pictures. I'm not going to put where anybody lives or even specifically buildings that we own. And we own a lot of buildings because people can find you, and every time you post something about yourself these days, what you're doing is eroding that privacy and that protection and that security. So I think it's a big concern.
Absolutely, that's quite interesting to learn. And I think there are two types of wealthy families. One are, of course, the secretly wealthy families, or people that are wealthy and can afford to be, secretive about their wealth, right? And then there are people, like you mentioned, some names: Elon Musk, Jeff Bezos. They cannot afford that kind of secrecy and privacy in their affairs, right? They're all over the news, right? How do they manage privacy, and how do they safeguard themselves and protect from all these bad things happening to them?
So when you're in that situation, you have your public story and your private story. So if you were saying, "Please, Wendy, tell me about the family you work for," there are things I would tell you. "Oh, great family, immigrant family, built their wealth doing this. They're very involved in the community." There are things I would tell you. What I wouldn't be telling you is the name of their kids, where they live, who the puppy dog is, exactly how much they're worth, which banks they have the money in, which funds they're invested in. So there is a wall between what you can share and what you don't share. And granted, what you do share still gives people tidbits, but I think it allows you, and allows Bezos and Rockefeller and all those guys to be able to run their lives and have that public facing bit, but also to protect their privacy. And it's just a fine line, and you just need a good executive on board with the family, all agreeing where that line will be about what can be shared and what can't be shared.
Absolutely, yeah, quite interesting. Um, and talking about family offices, we know for a fact that most family offices do not last more than 3 generations on average, right? But there are some family offices that have been really successful and have gone on for tens and tens of generations, right? What do you think the families that have gone on for tens of generations got right in their approach to managing their family assets?
I think they start training the next gen really young. So if you're first gen, you made the wealth, I think you're training your children at a very young age about financial stewardship, letting them know they are stewards. I think you're investing on a long horizon. And you can have a fund for more of the fun stuff if you're like really into startups or something. But you do have to have a long horizon on the investment. You need structure. You need to have all these things in and not just hope that people you gave birth to might be responsible. You need to put in those structures. So if they have a divorce or something, maybe that doesn't destroy the family's wealth because it's all protected and it's different little buckets. You need to plan. You need to do what I do, which is sit here every day and go, oh, what could go wrong with that? How could this come back and bite me? And then not have an anxiety attack over it, but set up everything you can to stop that from happening. And I'll give you an example. You're going to go build a house in Florida, right? It's the first thing you're thinking might happen if you build a house in Florida. Hurricane, fire,
Yep.
windstorm, flooding. So you're like, okay, well, it might flood, so I'm going to build it up so the water can go under. It'll be on stilts. It can't flood. Hurricanes. Okay. Now I'm going to get a hurricane force roof and I'm going to have it tied down into the ground, sunk so it can never get pulled off. And I'm going to get hurricane shutters and that way my windows won't. So you're planning, you're thinking ahead what could happen and you're starting to plan ahead, just like with the house. There were some houses that stood in California recently and they were all set up mostly by this one architect who used all these new special things because he wanted to make them as fire resistant as possible. And they're still there in the middle of a totally burned out thing. That's the family office you want, the house that's still standing.
Absolutely. And yeah, we were talking at that time when there are fires in LA, and a lot of losses have been occurred, and our heart goes out to them and the family suffering. But yeah, like you said, and I'm not sure why the other houses were built with wood, because I believe there was always a scare, because I've heard news that okay, firefighters always said that okay, that can happen. There's a possibility that a fire can break out if the wind goes the wrong way. That can happen. If that was a risk, then I think firstly the authority should have let everyone know to be careful with how the houses are built and everything, and also better preparation for the
Some of
same.
them were 100 years old, though. That's what they did in that day, right?
Yeah, that's right. I can understand that, surely. Yeah, got it. Awesome. Great. So let's talk about the venture capital asset class. Something we talk a lot about on the podcast. It's called VC10x, right? So how do you, as someone working with a family office yourself and having represented so many other family offices over the years, uh, how do you look at the venture capital asset class at this point from your perspective? Yeah.
I think most families look at it very differently um, than they looked at it pre-COVID. So pre-COVID, I think a lot of families I knew were, oh, venture, it's so very scary. I don't get it. I don't, I'm not doing that. Um, and then as COVID came in, the families did a pivot and they tried to help by investing in PPE, by getting ventilators, anything to help their communities, to help people. And then it occurred to them, or was pointed out to them, that they were kind of doing venture. And they're like, oh, that's not so scary anymore. Wow, okay, I'm already doing it. That's fine. And just like alternative assets, which have always been around, but there wasn't an asset class of alternatives until maybe the last 20, 30 years, right? It just wasn't talked about that way. And venture's now come into its own. Unfortunately, the last maybe year and a half, we've had it's been a kind of capital desert. People have had a very hard time raising in it. I don't think that means that it's dead. I think that it was a little bit on pause. I think there were a lot of things going on in the world that not just, oh, I don't want to invest in venture. So what I'm seeing is we're now starting back to investing. A lot of families are like, yep, I think I'm going to allocate. I think this is good. I want to do this. I think people are getting more sophisticated. However, you still have a lot of family offices who didn't make their money in venture, like we were talking about earlier. And to those families, I would say go into a fund. Go into a fund to fund if you can handle the fees. But if you go into a specific deal and you don't know what you're doing and you lose your shirt, then you're soured on the entire asset class. So I think for families that haven't traditionally invested in venture or heavily invested in it, that they really need to go the fund route. Let the experts make the decisions. You do what you do, which is get your return to preserve the wealth and learn about it. And I've found that most funds, and that goes for every asset class, if you say, I need you to teach me because I don't really understand this, take real estate guys trying to figure out hedge funds. That's a good example. Most people take the time and teach you. I do tell people, if you want to raise money for venture, offer a class. Offer Venture 101. Invite the families to come. They may never admit they don't understand it, but they'll sure show up and they'll sure be happy they did. And if you teach, they trust you and they'll invest with you.
Yeah.
So I do think we're about ready to see a lot more allocation into that space after this kind of dearth of funds for a while. I think a lot more families are comfortable with it. I just think that sometimes venture tries to be too specific in what its focus is on in the fund. So I've seen some, and I'm going to make up an example so I don't offend anybody. But we invest strictly in things for women under 25 who have siblings who are 50. It's too specific, right? A good venture fund is a good venture fund. And I get that some people want to have a particular focus, and I'm not saying they shouldn't. But if it's a little more general, you have more families who would be interested in investing as opposed to these hyper-focused funds. That make sense?
Yeah, that's quite interesting. I think like every family would have a different thesis around that. Some families would want to maybe just invest in the sector they are already in. Like you said, the first generation ones, especially, they want to just be in the same space and want to see what's the innovation happening there. But with the later generations coming in, they would probably want to take a more generalistic approach. But yeah, I think GPs, the fund managers, are now eagerly looking at family offices as a target LP, because that's a growing pool of capital, like growing family offices, a number of family offices in the world. People are getting more wealthier. And so when they're approaching family offices, what should be their approach, and what are the key points they should hit that family offices really want to hear?
Well, I would say there's two approaches. There's one, you're at a conference or an event and you're meeting a family office, and there's two, you've called up. I know family offices are very opaque, but don't call up a family office where you haven't done any research to find out who they are, how they made their wealth. I can't tell you how many calls I get. Could you just talk to me for a minute? Sure. Oh, hey, okay. I got you on the phone. I have no idea who you are, but so can you tell me everything, and then I'll decide if my fund fits you? That's not cool. Don't do that. Do a little research, see if we're a fit. Not every family invests in venture. And if they do invest in venture, they might not invest in your type of venture. You might be talking to the wrong person. It might be a third gen who's 22, who's great, very exciting, very intelligent, but they haven't even come into their trust yet. So they can't even use their trust distribution to invest with you. The easiest thing to do, if you're going to call or contact somebody, do a little research, see where they are, see kind of what they're posting, what they're doing. Don't send your deck on LinkedIn. It's a little phone. I can't read a whole deck on it. And I'm just like, what are you doing? Don't do that. Get to know somebody. Right? If you were getting to know somebody to go on a trip with them or something else, you're like, hi, how are you? Are you enjoying the conference? What did you like? What didn't? You don't walk up with your hand out or a card in your hand and say, hi, how much are you worth? What size checks do you write? Does it matter what size checks I write? Because I might not invest in anything you're doing. So that's kind of a silly question to ask. And what does my AUM have to do with it? If you're taking checks between 250 and 5 million and I'm worth 5 billion, it's an irrelevant number. You know what I mean? They're very, that's an invasion of privacy too. So I usually will look at people and go, I don't know. How much are you worth? Are you a good saver? What's in your bank account? What are the names of your kids? And people are like, wow, that's really rude. And I'm like, yes, it is. It's
Yeah.
really rude. Get to know somebody. Institutions are easy to pitch to, right? They don't have a lot of time. They get pitched a lot. They want your deck. They want to know how you think this is going to turn out. Are you going IPO? Everything. And it's very mechanical. They're nice people, but it's very mechanical. It's very different with the families. This is the show Cheers. They want to know who you are. They want to know about you. They want to know if you maybe know other people that they know. It's a little more, some families are very institutional, but it's a lot more and it will take longer. So you cannot go to a family and say, we're closing in 10 days. Would you like to write a check? No, we wouldn't. Our discussions, let alone our due diligence, would take longer than that. Not good for startups, but there are a lot of, and I get for venture, pensions and endowments, they write much bigger checks. So families are a good fit. But there are consultants that families use as well as endowments and pensions. That's like Mercer, and there's, I don't know, 100 of them. Maybe go talk to them. Does my, proposal look good? Get their sign off. This is a solid proposal. You guys have the experience, that kind of thing. So there are a lot of ways to do it. Just please don't send your decks on LinkedIn. Don't ask families their AUM. Don't ask them what size checks they write, because that's irrelevant. If they're interested in you, they'll say, what is your minimum and maximum, that you're taking. So just treat them like people.
Absolutely. Yeah. So number one is like, don't be transactional, because you just cannot be with family offices. And the first word of family offices is family. So you have to be very careful with that. That's a different pool of capital than the other pools of capital that you're trying to raise from, and be very considerate of that, right? And do not invade their privacy. Number two. And number three is that take a very relationship driven approach and not a transactional approach, kind of relating to the first point. But yeah,
and they'll stay with you. They'll stay with you through little ups and downs where
Right.
an institution won't.
Absolutely.
Because it's for them, it's a relationship.
Exactly. Yes. Yeah, I think that's something that a lot of GPs or people who are raising from family offices need to understand, that it's a different dynamic altogether than with any of the other type of LPs out there. Great. And talking about from the family office perspective, when you are looking at, individual direct investments into companies, businesses, startups, right? And then you're looking at commitments, LP commitments into VC funds, right? And then there is also the option of going into fund of funds, right? So can you share a brief about what's the risk profile in each of these categories, in direct versus VC fund versus fund of funds, and also the cost involved for the family office to invest in each of these categories?
Well, I would say direct is probably your highest risk, because it's either going to work or it's not. Now it's less of a risk in real estate than it might be in a hedge fund, because at least if things go sour in real estate, you still have the asset. Whereas in a hedge fund, if it all goes belly up, it may just go belly up. But if you're putting, my mother used to say, all your eggs in one basket, that's pretty risky. Funds are a little safer. It's the middle risk profile. You need to see who's running that fund, do your investigation, because they're going to be picking the deals that go in. So you're trusting them to do it for you. They usually are aware of what they're doing, especially if they've been doing it for 15 years. You can go look at their track record. You can see how they've done. So there's much less risk there. And the fees are reasonable because you're simply paying him, that manager, for the fees. So you're paying him to go make sure you don't lose your shirt. Really is kind of what's going on. Fund of funds. Fund of funds are fund of funds. Uh, there's a lot of fees. Families are very fee adverse. So now you have two levels of fees. So if you're going to go into that, usually a family will want to know that fee structure. Like, how much at the end of the day am I going to get clipped on fees? Because even if you make a 12% return, if they have fees and they have their GP takeout, they have their fees and they have their fees, I might get 1%. I need to know what I'm getting. Do you have a hurdle? How is this all working? But the good part is it's very low risk because they're investing in all these fund managers who know what they're doing, if they've done it for a while. I don't like people that just have come in out of the blue and said, I'll be a fund to fund and I'll get your money and I'll put it in these 10 managers that everybody knows are the 10 best, so the returns won't be high, but it'll be very safe, and I'll take a fee too. Okay, but I'm not going to make anything. I could go buy treasuries for that and clip 5%. We'll kind of be in the same boat. So I think, you have to say, how much risk can I tolerate? How smart am I? Is this where we made the money and we really know what we're doing? Or is this something we've never done oil and gas? We want to put money in oil and gas. But we don't know anything about it. So I really can't go buy a well in Texas, even if it's a tick interest, because I don't know what I'm doing. So how do I get in that asset class without losing my shirt? Well, maybe I want to do a fund. Maybe I want to go to a multi-family office and they know all of them and they'll pick it for me. So that's kind of the game you have to play to see what you can tolerate, what your experience is in, and how much it's going to cost you for that safety level.
Absolutely. And talking about the cost structure, where does a multifamily office sit among all these three?
You mean among like fund of funds, direct funds?
Yes.
Well, I would say it sits off to the side, but probably more aligned with a fund manager. If it's an open architecture multifamily office where they're being a fiduciary, you've put in 10 million, they're going to spread you out over the 12 asset classes and they're charging you 1%. If it is not open architecture and they have their own products like Goldman, Morgan, whatever, they might get higher returns, but the products they're selling you are their own products with a fee built into the product. So you may be paying much more fees than that 1% for the fiduciary, but maybe they've designed it so that it's pulling minerals from Mongolia, which no individual manager could do. So there's pluses and minuses, but if I had to put them there, I'd kind of put them next to a fund manager, depending on the structure of the multifamily office.
Right. Yeah, thanks for sharing that. And my last main question before we try to close this out, what are some common mistakes that you see family offices make?
I would say that governance is a big one. So I won't say which family this kind of occurred, but what happens is that families get busy like anybody else. And sometimes they just hand off responsibilities to their staff. And we're good people and we're very good executives, but every once in a while you'll get somebody who maybe isn't good. And if you don't have those rails in place, you can really end up being embezzled from. And that's a hurtful lesson, and not just financially. That hurts trust and that hurts the heart. So you're better off putting those governance structures in place and putting all the safeguards for the banking information and everything else in place. No true executive is going to be offended by that. In fact, they're going to sleep better at night because you've been willing to do that. This could go wrong. And then that way there's a lot less mistakes. I think another mistake they make on a more emotional level is they assume these cute little kids they have that are just adorable are going to grow up to be cute little people. And some will. They will never be divorced. They'll never have a drug problem. They'll never have trouble with money. They won't gamble. And so why go through all this money and this big mess to put in these structures? Because they're perfect. But they're perfect till they're not perfect, right? And again, nobody wants to live under the cloud of doom all the time. I get that. Let your executive do it. Let your executive be the little cloud of doom so that you can have a great life. But a good executive will be thinking, we can't do this. Whether or not the family listens to them is where they can get it wrong. Because if you don't prepare for it, it can really come out and get you. If you prepare for it, it's a smooth ride.
Yeah, quite interesting. And I just have one last closing question, somewhat relating to what you mentioned. You worked with a lot of wealthy families. How much percentage of those people, or in general, would you say, are truly happy with their lives, with the wealth that they have?
I think that, I just run one family office, but I've been around a lot of families, family members, and all that. And I think most of them are very happy. They don't have to worry about a place to live. They don't have to worry about where their next meal's coming from. But the trade-off is you have to be suspicious of everybody. And think about that. Everybody you meet, you have to wonder, do they want to meet me for me? Do they like me? Or do they just want to, clout climbing? Or do they, want to get my kids to marry into wealth? So, and it's not fair to the people who are trying to be your friend or meet you or, be a part of your life. And it's not fair to you. But you've constantly got to be like a little on guard. And can you go to this event, or is everybody going to want to take your picture? Oh, that's an important wealthy person. Can we take a selfie? So it's you, there's a trade-off for the security of wealth. There's a big trade-off in trust and your ability to maybe have normal relationships.
Yeah, that's
I
quite
think they're
interesting.
happy. I think
Yeah,
most of them are pretty happy, but
yeah,
there are some sad times. And on that note, I would say too, um, when you have a family member who has a drug or drinking problem, when do these problems stop? Usually when you hit the bottom. How are you going to hit the bottom if you're a family member? It's tough.
right.
So happy,
Yeah.
yes. Same problems as the rest of us a lot of times, and a few specials.
Right. Quite interesting. I think it's a dichotomy of wealth wherein, on one hand, it gives you freedom. You can have anything that you want, but also on the other hand, you have to be somewhat subdued and always suspicious of everyone, which is kind of different from how a normal person would live his life, right?
Yep.
Which you are deprived of because
Yeah,
of your wealth, right? That's
that is
interesting.
correct. That is absolutely correct. Well
Yeah.
said.
Yeah. Very interesting. Wendy, it's been great talking to you. Thank you for making time. I've been wanting to have you on for so long. And can you share any links? I know you're very privacy focused, but anywhere where our people can go to and learn more about what you do?
Oh, yeah. You can get me on LinkedIn. It's locked out because there's a lot of families on there, but just make a request. And, I look at it probably once a week. Happy to do that. Kirby Rossbach has a book called The Family Office. There's a lot of books out there that you can look at. Somebody needs to do Family Office for Dummies. I think that would be great. But there are a lot of resources in the space. You just go on Amazon or Google and you can get books and kind of start getting into it.
Absolutely. Yeah. Thanks for all those resources as well. I think will be very helpful for our listeners. Thanks so much for doing this, Wendy. Look
You're
forward to
welcome.
getting this out. Have a nice day.
All right, you too. Thank you.
Thank you so much.